People always come to me and they ask me, what is the Fed? What's a central bank? We're going to go through that in 10 minutes. By the time you finish with this, you'll know clearly what is the Fed and what is a central bank. Welcome to With Wellner Anderson. This is the channel where we talk about economic, financial, and we talk about things that do with maybe business or something like that, but in very simple terms. So, what is a central bank? We're going to talk about why do we have one? Why do they inflate and deflate the economy? Why was the Fed created? And a brief history of the Federal Reserve System. Federal Reserve System is not a federal agency. It's not owned or unfolds under any federal agency. It has no reserves, at least hard reserves, and it's really not a bank. First of all, it's about money. Being the Federal Reserve's goal is to manage the money supply, let's figure out what money is. Money, its main instrument is trust. Money is fungible, which means a $5 bill can be exchanged for five single dollar bills, which can be exchanged for quarters that add up to the same amount. Money must retain its value. It can't be something that that has, like, for example, in Holland, they had tulips. That was money. It can't retain its value. It's got to be divisible. It can't be rocks or animals. It has to be used to pay taxes, which means it's legal tender. And as I said before, it can't be perishable like tulips. And the main thing, money has to be scarce. So now we understand what money is, and that's what the Federal Reserve is responsible for managing. I'm going to go through a Goldsmith story, and you're going to understand why this makes sense. Back in the old days, when people had gold, they needed one central spot that they could leave their gold and made sure that it was protected. And this is where the goldsmith came in. People would bring their gold to the goldsmith, and the goldsmith would lock it in his vault and issue them a receipt. What the goldsmith found was that the receipts began to circulate. No one really came back and asked for their gold. So being it was in a safe, secure place, and no one came back from their gold, some of the goldsmiths began to issue additional receipts. That's pretty much when people call, when you hear the term printing money, that's pretty much where that came from. Okay. All major economies have a central bank. The Bank of Japan, the Bank of England, the European Central Bank. And their all goals really are manage and supervise the banks, control the money supply, control inflation, things of that nature. The Federal Reserve Bank of the United States has two major criteria: full employment and stable prices. Before the Federal Reserve Bank existed in the United States, believe it or not, there was a time that was called the free banking period, where literally there were hundreds, maybe even thousands of currencies in circulation. You'd have currency from XYZ Bank. You'd have currency from an organization, and it worked for a while, but you can imagine what it'd be like when you had to exchange currencies with someone, working out the change and things of that nature. There were private currencies and that really was one of the reasons why it made sense that some central organization controlled the money supply. Now, let's talk briefly about what it was like before you had a uniform money, as I talked about before. And let's talk about money supply, or inflation, which is one of the goals of all central banks. I just want to give you an impact on the power that they have and the power it is to control the money supply. During the Civil War, the Union Army, when they invaded Richmond, discovered the printing press for the Confederate currency. They destroyed the printing press. When that happened, the Confederate currency balanced. It was worth something. The Weimar Republic, before Adolf Hitler came to power, because of the power of inflation, people were paid 3 times a day. Once in the morning, once in the evening, and once in the afternoon. Because their money would change values at different times. The Roman Empire, Diocletian, the whole Roman Empire failed because of inflation. Because lack of confidence in the money. Diocletian would take gold coins and add alloys to it to reduce the value of the coin. So, there isn't a need for an organization like in the case we said before, where there was literally hundreds of currencies, and in the case where someone can debase or print currency, there is a need for someone to handle that. That brings us to the story of the United States Fed. We're going to start in 1907, when there was a panic, which they called, before they called them recessions, they called them panics, a lot of them. And J.P. Morgan, the famous banker, had enough clout to bring that to an end. When, at that time, he had also had some of his people get together. A group of people got together in a place called Jekyll Island, Georgia, and they put together the underpinnings of what the Federal Reserve System would be. The people that met on that island controlled about 40% of the world's wealth at that time. So, the Federal Reserve System in 1913, the Federal Reserve Act was born. Of that, coming out of the act or the agreement that they made on Jekyll Island. And what happened also in 1913, the Federal Reserve Act again gave the banks in the United States again stable currencies and protecting the economy. The Federal Reserve Act allowed for the next act to come along, which was in 1913 at the same time, the 16th Amendment, or the income tax came along with the Federal Reserve. How curious would they put in a federal bank and also attach a funding source to it? In 1933, the federal government was tethered, dollars were tethered to gold. So it was very difficult to inflate or do what the goldsmith said you couldn't issue receipts. Franklin Delano Roosevelt in 1935 detached the dollar from gold temporarily because he knew he needed to inflate the currency. And if gold was tethered at $20.60, he could not produce enough currency out there to pay for the war effort. Eventually, the United States dollar replaced the gold as the world standard. And by 1971, President Nixon detached the gold from the dollar, which is where we are today, which is free-flowing currencies out there. So, remember, the Federal Reserve is a private system. They have no reserves. They are not really a bank. Their goal is to manage the money supply and protect the currency. But the issues that go on is because their currencies are not attached to anything or tethered to anything of value, they continue to print money. It's sort of like if you check your coat check, a nice coat, and you go in and watch a movie and you come out and they give you a cheaper coat. It's just sort of like what goes on in inflation and the Federal Reserve and central banking. I do thank you very much for your time. Please give me a thumbs up. And if you are on YouTube, please subscribe. Thank you and have a good day.